Hello there. I hope that you're doing well. Welcome to the first lecture of the swing trading series. During this series, I will explain to you how you can apply the concepts which I've taught you on the lower time frames to the higher time frames if you're interested in participating in swing trading. Before you watch this lecture, I want to make it known that this lecture is not meant to watch as your first lecture of my mentorship. Meaning, if you're completely new to my mentorship, I highly suggest you to look at my older lectures first, such as the model series and such as the other typical lectures, such as the predicting price series. The reason why is because during this lecture series, I will be speaking to someone that has gone through the majority of the content released prior to this series, since there are a lot of similarities when it comes to how I've taught you to look at the lower time frames and how I will teach you to look at the higher time frames. When it comes to swing trading, a lot of people think that swing trading is completely different than lower time frame trading. However, the only thing that is different is the duration of the moves playing out, because time is time and price is price. Both are fractal. So with that being said, let us begin with this first episode of the swing trading series. This is the first series for the 2025 mentorship. Who is this series for? This series is meant for the trader that does not want to trade intraday volatility and is much more inclined to focus on higher time frame price swings. This trader is comfortable with being in positions for days, weeks, and maybe even months. Meaning, this trader is comfortable with being in a position for a rather long time compared to an intraday trader. Where an intraday trader could be in and out of the market within less than 30 minutes, for swing trading this is of course not the case. Therefore, you need to have a lot of patience. Time frame alignment. The time frames that we will be utilizing during this series are the following. We will be paying attention to the monthly, weekly, daily, H4, and hourly charts. The higher time frame analysis will take place on the monthly, weekly, and or daily charts, meaning these are the time frames which we're going to utilize in order to frame our higher time frame analysis for the swing trades. The execution timeframes, however, are going to be the daily, H4, and or hourly charts. During this series, my goal is to provide to you a swing trading model which can be applied across all markets, regardless of time frame. Meaning, you can literally just pick the market that you're interested in and you can look for the signatures which I will be teaching to you. The signatures, again, are very similar to the lower time frame signatures, because all we are doing is increasing the duration of the time cycles which we're using and the size of the price ranges which we're using. Yep, the size of the price ranges, you heard it right. And therefore, the way that we're going to look at the markets isn't going to be really different. So if you're into swing trading, don't think that all of the other content on my mentorship is completely irrelevant, because it's not. Even if you're not interested in swing trading, particularly meaning if you're still interested in intraday trading, this series is still going to be beneficial to you, because it's going to teach you how to properly frame a higher time frame analysis and how to know where the markets are drawn towards on the highest possible time frames. The expectations for this series should be as follows. Swing traders take around 1 to 2 trades every week or every few weeks, depending on the time frames that they're trading upon, of course. All a swing trader cares about is where price is drawn towards from A to B within the upcoming week or weeks. Position size is smaller than day trading due to bigger invalidation sizes, meaning the amount of points or pips between the entry and invalidation is of course way bigger for swing trading than for intraday trading. Therefore, position size accordingly. With swing trading, the same trading concepts apply, but within a much bigger time cycle. With that being said, what I will share with you is some chart examples of swing trading opportunities. I'm going to walk you through the use of bigger time cycles and the same concepts as we do on the lower time frames, but now on bigger time frames. Now, for all the examples which you will be shown during this series, I will be referring back to analysis which I've shared in real time throughout 2024. The reason why I'm doing that is due to the following. There are a lot of people nowadays that teach these theories, they teach these concepts on the markets, and they go out here and they say, look, this is when and where it happened, and they just pick random examples. What I am, however, doing is I'm only showcasing examples to you which I literally called in advance before they played out. Meaning, the example which you are shown right now is the sales which took place on Euro throughout the fourth quarter of 2024. If you're completely new to my mentorship and you haven't watched the market reviews of 2024, you can go back to those market reviews and you can listen to the market reviews in which I was calling that we would likely see Euro be repriced towards the downside soon. That is the first breakdown which we're going to take a look at. What I want you to see is that Euro was consolidating. Euro was stuck inside of this range from high to low and was going back and forth, back and forth. When the fourth quarter then came, what we saw was that Euro began expanding towards the downside. When we pay attention to the high of this range, you can see that the high was the 2023 high. Because we were trading in 2024, we pay attention to the previous year's high and previous year's low. This low, however, was not the 2023 low, but that doesn't matter. Why not? Because this low formed after the 2023 high was established. This resulted in consolidation taking place. Therefore, I look at this low to be the low of the consolidation. What you can see is that the market expanded in close proximity to the 2023 high, but it did not take it out, and it still reversed and draw towards the downside, drawing towards this sell-side liquidity pool and this imbalance which was present right here. You might be like, why did that occur? There's no purge of the 2023 high. How were you still anticipating lower prices throughout the fourth quarter then? When we pay attention to Euro, its respective weekly chart on the left, and GBP, its respective weekly chart on the right, what you can see is that Euro was repriced towards the upside and it stopped right in advance of the 2023 high. When we, however, pay attention to GBP on the right, what you can see is that GU was repriced higher above the 2023 high. Therefore, we saw yearly SMT taking place between Euro and GU. We then saw the signs of a reversal taking place. Notice that a bearish breaker formed, where we saw a high form, low, inside of a small BC, higher high, lower low. This down close candle is now a bearish breaker. When we pay attention to GU, we also saw a bearish breaker form, where you can see that we formed this BC. We then formed a high. The market retraced into that BC, expanded higher, and we then saw the market close below this low, the low which formed inside of this BC. See a retracement taking place multiple times into this candle right here, and the market is rejecting that candle multiple times before expanding lower. Now, the main takeaway from this is the following. The main takeaway is that because we have that bigger time cycle SMT, that yearly cycle SMT, we can anticipate that we're likely going to draw towards the opposing side. What is the opposing side? The opposing side is, of course, sell-side liquidity. Because who is making money all throughout this repricing higher? Buyers, of course. Therefore, we can anticipate that to end the year, we're likely going to see sell-side delivery next. And that is why I was leaning towards the downside throughout the fourth quarter on Euro and GU. And this was paired with a very bullish door analysis as outlined. And that is something which I really suggest you to go through the reviews of 2024 and investigate. But with that being said, let us pay attention to the... it sounds weird hearing me say this, because I'm going to say lower time frames, but we're still going to pay attention to a daily chart. So you're going to be like, how could a daily chart be a lower time frame? Put things into perspective, guys. We came from a monthly chart. So relative to a monthly chart, the daily chart is, of course, a way lower time frame than the monthly chart. And that is why I'm referring to the daily chart as our lower time frame chart now. Everything is fractal, guys. When we pay attention to the daily chart then of Euro, what you can see is that I've put the risk to reward tool here and I've put a CB right here, which I've annotated. Notice that we saw that purge of this high form right here. We saw a purge of buy-side liquidity taking place. And we then saw intermarket relationship between euro and the dollar. And this is what I need you to investigate on your own charts, by the way. I've decided to not annotate this because I want you to go into your own charts to see the level of detail right here. What I want you to see on your own is that when you compare euro to the dollar right here, you will see that there was a very tiny SMT right here. So we were aware of the fact that we had that bigger SMT relative to this price level right here, relative to that 2023 high. And we saw the market eventually then roll over. It began to show the signs of bearish order flow stepping in. We saw a breakaway gap form and the market displaced through this low. This low was a previous month's low. Therefore, we were anticipating that as long as this low would function as resistance on price, we could anticipate lower prices to take place. Notice that when we saw the market retrace, we failed to retrace into this low, meaning the market never retraced throughout the month of October into the September low. That right there is screaming bearishness for the remainder of the quarter, and that right there is showcasing to you that they're likely going to reprice it towards all of the sell-side liquidity engineered below these lows. Because when you pay attention to these lows, you can draw a very clear trend line and extend it to the right. So everyone was bullish on euro, everyone was anticipating higher prices. But when the time was right, IBDA had other plans. Now, the daily chart could have been utilized for an execution for a swing trade, because the retracement into this CB right here is already an IOFET, an institutional order flow entry drill entry, as you can see. The invalidation for this idea is this CB right here. We wanted to see this CB be left open. This CB is our breakaway gap. The reason why is because this was our previous month's low, the September low. So this candle has to function as resistance on price. But this is also a bearish breaker. So you have multiple things lining up there that showcase to you that this downgrowth candle should never get displaced through. And that is why we can enter in this CB, but we must allow for the market to retrace into that low before potentially expanding towards the downside. Now, when it comes to the management of this position, you might be wondering, how could this trade have been managed? Well, what I want you to see is that the market expanded very quickly away from this CB right here. When this expansion leg lower occurred, what you can do is the following. The moment that price expands lower and it displaces through imbalances on the left side of the curve right here, your stop can be drilled from the breakaway gap where it was placed initially to the entry, meaning you're removing risk on this position, and the next retracement which takes place, so for example this retracement higher into this old retracement on the left side of the curve, meaning pay attention to this retracement leg lower. On the buy program, what I want you to see is that there are a lot of retracements, right? There are a lot of back and forth goings on the buy side of the curve. We can extend these retracements to the right to determine the ranges that price should not displace above if bearish. Therefore, pay attention to this high, to this low. We can extend that to the right, and the moment that the market closed below that range, we want to see that range function as resistance on price. It's a must, and therefore our stop can be drilled to break even, because the market should never come back above this high again. It has absolutely no reason to come above that high unless our idea is wrong. And this is how we can enter based upon the daily time frame. Now, throughout the month of November, we of course had the US elections, and that is why you saw this big expansion leg lower taking place afterwards. But this was the most ideal entry for this swing position throughout the month of October. Now, with this bearish idea in mind, you could either execute of the daily time frame, but you could also zoom into the hourly time frame and try to fine-tune your entry. Now, because this is a position which is likely going to run for a few months' time, this is not the type of situation in which I would suggest you to go into the hourly time frame. The reason why is due to the fact that if you try to fine-tune your trades too much, you are actually making it harder for yourself to get into these type of moves. Because if you would just focus on participating in the market move from a higher time frame swing. I'm not telling you to go out here and invest and trade for your info, but I'm just speaking in terms of if you would decide on your own to participate in a higher time frame swing like this, where you're holding on to a position for weeks, if not months, right? Why would you go into an hourly time frame and try to fine-tune it onto a 15 or even 1 minute time frame, right? It's overkill in my opinion. And the reason why is because the returns on this trade are already phenomenal. If you participate in a swing trade like this every quarter, do you need to do more than that if you size properly? Of course not. And that's the whole paradigm that a swing trader has, where a intraday trader is participating in market moves multiple times a month. A swing trader doesn't have that mindset because the position size behind the positions is smaller, right? But the amount of points, or in this case pips, that are being captured are way bigger than an intraday trader. And therefore, the risk per position can also be increased in terms of percentage due to the amount of executions which are taking place. But that's something which we'll discuss later during the series. We're now going to take a look at Nasdaq buys which took place during the second quarter of 2024. What you can see is that I've plotted the yearly open utilizing the time cycles indicator, and next to that I've plotted the monthly and weekly open. Next to that I've annotated specific imbalances, this BC and this CB. What you can see is that throughout the first quarter, we saw the Nasdaq expand towards the upside. But whilst we are looking at this expansion higher, you can see that there was a lot of back and forth going right here. Meaning there was a lot of chop, as I usually call it, of course. Due to this chop taking place, what we can anticipate is that at one point in time, we are likely going to see the market drop suddenly. We are likely going to see it gravitate towards all of the sell-side liquidity engineered below these lows right here. Because we can draw a very clear trend line, as you can see, below these lows. Therefore, when the second quarter opened up and we saw the market begin to drop towards the downside, we were monitoring the reactions to the falling range. We're monitoring the reactions to this specific BC right here. This BC was important because it displaced through the yearly open. The market dropped below the yearly open and it dropped into that BC's range after having taken out sell-side liquidity resting below these lows. We saw the market then form a low and it began repricing towards the upside. At this moment in time, it is however not confirmed yet that we have in fact seen a change in the state of delivery on the higher time frames and that we're going to see a byproduct unfold soon. We see the market retrace and a new month opens up. The month of May opens up and the market initially drops lower below the opening price and it then begins to expand towards the upside. It begins to run higher. Notice that it displaces through this CB right here. This CB is very important, and the reason why the CB is very important is due to the following. When we pay attention to the left here, you can see that that CB displays through this low. This low is important because if we look to the left again, notice I'm moving to the left twice here, one time, two time, we can see that the low formed inside of this BC. If we would have seen the market find resistance inside of this CB, inside of this down close candle, or inside of this BC, then we would have anticipated lower prices. But because we close above this CB and we form a new BC here, we can anticipate that we're likely going to see a retracement into that range before further continuation higher is taking place. Why? Because when we pay attention to this original consolidation, you can see a lot of back and forth going. And guys, because Nasdaq was trading at all-time highs, this is not how a market tops. Meaning, a market doesn't top out of a consolidation. It doesn't happen because this is the engineering of more buy-side liquidity. Retail mind traders are seeing bearish signatures. They are seeing bearish trend lines getting created. They are seeing resistance, so to say, getting reached. And therefore, we can anticipate continuation higher taking place once we have dropped lower first to trap retail into believing a swing high is in, so that we can then basically fill our long orders so that we can distribute against that. And that is the whole smart money paradigm. and it's about looking at the markets from a completely different perspective than the masses. Now, when we compare intermarket relationship, we can see that Nasdaq is shown on the left and ES is shown on the right. What you can see is that I've annotated the February low. And the reason why I've annotated the February low is because the February low is of course a monthly low. Throughout the next months, we are paying attention to this previous month's low to determine whether or not intermarket relationship is confirming to us that we're likely going to see a specific program unfold. What I want you to see is that Nasdaq dropped below the February low, whilst ES created a higher low throughout the month of April relative to that low. That right there is telling to you that a bigger SMT is in play. So the moment price displays as higher, it's the sign, all right, we're in a buy program officially now. And that is one of the main takeaways that I want you to understand within this first lecture of the swing trading series. Pay attention to bigger time cycles. Pay attention to yearly highs and lows. Pay attention to quarterly highs and lows, and pay attention to monthly highs and lows. And when you see a big SMT with a highly correlated or inversely correlated market, that right there is the first big warning sign, if applied within the proper narrative, of course. Here we're on the 4-hour chart of Nasdaq. And as you can see, I have annotated that daily CB with this blue box. I've extended it to the right. What I want you to pay attention to is what is occurring right here. Notice that throughout the repricing outside of that daily CB's price range, multiple imbalances are forming on the 4-hour chart. Meaning you can see that the market displaced really on the hourly chart above that CB's range. And the creation of these imbalances is showcasing that to you. Notice that the market then retraces into that daily CB's price range. And what you can see is that we repriced into that daily CB and then rejected it right away. Notice how the market is reacting off the higher end of this bigger blue box. As you can see, I've placed the RR tool inside of that daily CB's price range. And I've placed the stop loss, the invalidation, below this low. The reason why this low is important is because for this specific week, this was Monday. And in a trending environment, and an environment in which we're anticipating a low resistance liquidity run towards the upside, we are anticipating that the previous day lows, and in this case especially the Monday low, is likely going to be left intact. Why? Because we have a sequence of imbalances which formed right here through that daily CB. Therefore, the retracement into that specific range is a potential entry, and the invalidation for this idea would be if price would displace below this low, and that is why our invalidation can be placed there. If we pay attention to time more, you can see that entry took place throughout the New York morning session, where we dropped lower into that specific daily CB's range, and into the sequence of imbalances throughout the New York morning session. And that right there is New York reversal daily profile. And this right here is where we're entering simply based upon that higher time frame point of interest. Where as a intraday trader, we would be zooming into the lower time frames, looking for a market maker buy model opportunity. As a swing trader, we're simply entering it here with a wide enough stop, and we're targeting our higher time frame objectives. Now, this right here is a method of entering which is quite, I would say, unfamiliar to the majority of you. And that is because you have always been taught to look at breakers and mitigation blocks by me. However, when you're looking at swing trading, you're not going to go into the 1 minute time frame and look for your entry if you're trading a swing which is likely going to take place over a couple of days or weeks. I'm not saying that it's not possible, but I'm saying that it's way more stress-free in order to just enter off the higher time frames. And that is what my focus will be throughout this lecture series. And what you can see is that the market expands into the anticipated direction of that drawing liquidity, of that all-time high. And when that gets taken out, you see further continuation taking place eventually. Now, what is so important to note is that when it comes to swing trading, you need to submit the time. Meaning you need to allow for the market to retrace multiple times into your entry area before you see the expansion taking place. And with that, I want to end this first episode of the swing trading series. During this episode, I have provided to you a general idea of what swing trading is like and for who this series is meant. And I've also provided you with multiple examples of what swing trading opportunities look like. During the upcoming episodes, I will teach you more when it comes to objectifying your swing trading approach and how to actually determine the drawing accuracy and how to get in sync with these price swings by IBDA. I hope that you enjoyed this first lecture of this new series. And if you are an intraday trader, I'm sure that you took some gems away from this. Just apply a different time cycle, different time frame, and the same logic applies. I want to wish you all the best, and I look forward to catching up with you in the next episode. Be safe.